Right now, 3.1 million unsold cars are sitting on dealer lots, a 30% jump in just 1 year. Meanwhile, car loan interest rates have skyrocketed to 7.2% for new cars and 11.4% for used ones. Imagine a buyer walking away from their dream car because monthly payments are now out of reach. These numbers aren't just statistics, they're signals of a brewing crisis. In this video, I'll break down the data behind the looming automotive market crash. From post-pandemic price surges to predatory financing and new tariffs, I'll explain what's happening and why it matters. Stay tuned, this is critical information. The $1.7 trillion time bomb. Imagine owing $6,838 more on your car than it's actually worth. That's the average negative equity for millions of Americans right now, a staggering financial burden that's becoming increasingly common. Auto loan debt has ballooned to $1.7 trillion, a number so massive it surpasses the entire GDP of Russia. Why does this matter? Because it highlights just how deeply entrenched this issue is in the economy, affecting everyday Americans who are struggling to stay afloat. Nearly 1 in 4 trade-ins now come with over $10,000 in negative equity, according to Edmunds data. This means there's a 25% chance that if you trade in your car today, you'll still owe more than $10,000 on a vehicle you no longer even own. For many, this isn't just a statistic, it's a harsh reality. On Reddit, people are sharing their financial struggles, painting a vivid picture of what this crisis looks like in real life. One user wrote, "I owe $32,000 on a car worth $18,000. My payment is $689 per month for 72 months. I can't refinance because of the negative equity." Another shared, "Dealer rolled over $8,000 from my last loan. Now I'm paying $820 per month for a base model Civic." These stories show how quickly debt can spiral out of control, leaving people trapped in loans they can't escape. The average negative equity hit an all-time high of $6,838 in Q4 2024, up 42% from just 3 years ago, according to Experian data. This sharp increase is part of a dangerous cycle. When you trade in an underwater car, dealers often roll the remaining debt into your new loan. Suddenly, you're financing not just the new car, but also the leftover balance from the old one. This creates a snowball effect, where each new loan becomes harder to manage than the last. Refinancing used to offer a way out of this cycle, but that's no longer the case. With used car loan rates now averaging 11.4%, refinancing has become nearly impossible for most borrowers. Even those with excellent credit scores, 760 and above, are facing rates as high as 7.2% on new car loans. The system is designed to keep borrowers trapped. Once you're underwater, lenders know your options are limited. You either keep making payments or risk defaulting. This isn't just a personal finance issue, it's a systemic risk. When millions of people owe more on their cars than they're worth, the entire auto finance system becomes unstable. Repossessions have surged 38% year over year, according to Fitch ratings, and defaults are rising even among borrowers with prime credit. The auto loan crisis in 2025 is shaping up to be worse than anyone predicted, with ripple effects that could impact the broader economy. Pandemic's lasting scars. March 2020 marked the lowest point for auto production since World War II. The U.S. International Trade Commission reports production levels dropped to what we last saw in 1945. For weeks, drone footage revealed factory lots eerily empty, where thousands of vehicles should have been rolling off assembly lines. At least 93% of U.S. auto manufacturing ground to a halt during those early pandemic months. Plants began reopening by late April 2020, but production didn't recover overnight. According to the USIC, it wasn't until July that output returned to 2019 levels. The Bureau of Transportation data paints a stark picture. The U.S. produced over 2 million fewer vehicles in 2020 compared to the previous year. Domestic car sales mirrored this decline, underscoring the scale of the disruption. The initial shutdowns triggered a supply shock, akin to a sudden earthquake shaking the foundation of the industry. But the real challenge came when demand surged unexpectedly. Stimulus checks hit bank accounts while people were stuck at home, rethinking their transportation needs. Many opted to spend that money on cars, especially as public transportation felt increasingly risky. Meanwhile, semiconductor manufacturers pivoted to meet skyrocketing demand for electronics like laptops and gaming consoles, driven by the remote work and entertainment boom. This shift in focus created a bottleneck for automakers. Modern vehicles depend on semiconductors for everything from engine management to touchscreens, and the shortage quickly became a choke point. Trade restrictions with Chinese tech firms like Huawei added another layer of complexity. Some companies began hoarding chips, bracing for future shortages. The result was a perfect storm: low supply colliding with high demand, leaving automakers scrambling to adapt. By 2021, production numbers inched upward but never fully rebounded. Sales remained sluggish, as Ward's intelligence data shows. The OECD raised alarms about the fragility of global supply chains, warning that the pandemic's ripple effects were far from over. What began as temporary factory closures evolved into long-term production constraints, reshaping the industry's trajectory. Dealer lots, once brimming with options, became barren landscapes in 2021. Customers faced months-long waitlists for popular models, with delivery times stretching to unprecedented lengths. Manufacturers, constrained by limited production capacity, prioritized high-margin vehicles, leaving fewer affordable options on the market. The scarcity sparked fierce competition for available vehicles. Auction prices for used cars soared as rental companies and dealers scrambled to replenish their inventories. Wholesale used vehicle prices jumped 37% from 2019 to 2021, according to Manheim data. This surge rippled directly into retail prices, forcing consumers to pay significantly more. At the worst points, new car inventory levels dropped to under 30 days' supply, less than half the traditional 60 to 70-day benchmark. This scarcity gave dealers unprecedented pricing power. MSRPs, once a ceiling, became a starting point. Customers often paid premiums just to secure any vehicle, let alone their preferred model or trim. The production gaps left a lasting mark on the industry. The USIC report highlights how the 2 million vehicle deficit created a hole automakers are still struggling to fill. Those missing cars represent billions in lost revenue and untapped consumer demand, a reminder of how deeply the pandemic reshaped the automotive landscape. The MSRP lie. 82% of buyers paid over sticker price last year. But here's what dealerships aren't telling you. The manufacturer's suggested retail price has become meaningless as dealers impose massive markups on nearly every vehicle. We've seen window stickers showing $5,000, $8,000, even $12,000 in market adjustments on common models like Honda Civics and Toyota RAV4S. Base model sedans with cloth seats and plastic steering wheels, not luxury vehicles. This markup system starts at auctions, where dealers acquire used inventory. Spyony.ai data shows that dealers typically add 10 to 35% to the wholesale price before putting cars on their lots. For example, a $15,000 auction car becomes $20,250 with a 35% markup. Trade-ins feed into this system as well. Dealers offer you wholesale value for your car, then mark it up 30% or more for the next buyer. The average trade-in age is just 3.6 years, according to Edmunds, meaning relatively new cars are cycled through this profit machine. Together, auction markups and trade-ins create a system where every step inflates prices for buyers. Consider this real case from Texas last month. A buyer paid $8,000 over MSRP for a base model 2024 Honda Civic LX. The sticker price was $24,845, but the dealer tacked on a $5,000 market adjustment, $1,200 for nitrogen tires, $800 for paint protection, and a $1,000 dealer fee. The final price? $31,845 before taxes. That same car would have sold for under $23,000 before the pandemic. The buyer told us, they said take it or leave it. 15 people were waiting if I walked away. This story isn't unique. It's a snapshot of how markups and mandatory add-ons have become the new normal. These add-ons are like a hidden fee tax, baked into the price before negotiations even begin. Dealers now require purchases like $400 floor mats, $700 security systems, or $1,500 extended warranties just to complete a sale. One dealership group in Florida was caught charging $2,495 for theft protection stickers that cost just $5 to produce. These aren't optional upgrades. They're mandatory charges disguised as extras. The numbers paint a clear picture. In December 2024, the average new vehicle transaction price hit $49,740, according to industry data. That's 1.3% higher than the previous year, even as inventory levels grew. Manufacturers offered average incentives of $3,500, or 7.2% off MSRP, but prices still climbed. Vehicles under $30,000 were hit hardest, with over 80% facing significant markups. The most vulnerable buyers, those shopping for affordable cars, are the ones paying the steepest price. Used cars follow a similar pattern. In December 2023, the average used vehicle listed for $25,128, while dealers typically paid $18,000 to $20,000 at auction for those same cars. The $2,500 average markup doesn't even include reconditioning fees or mandatory add-ons, which push profits even higher. Specialty vehicles see even more extreme markups. For instance, we found a used Ford Bronco priced $28,000 above its original MSRP. Dealers rely on sophisticated software like vAuto to track market demand in real time. If a car gets lots of online views, its price can increase that same day. One dealership manager admitted, "We change prices 3 times daily based on website traffic." This dynamic pricing creates artificial scarcity. Even when inventory builds up, prices remain high because the algorithms indicate they can be. This system creates perverse incentives. Dealers often prefer to send unsold cars to auction after 60 days, rather than significantly lowering prices. For example, a 2023 Honda Accord priced at $32,000 today might wholesale for $24,000 next month if it doesn't sell. But instead of discounting it by $3,000 now, dealers gamble on finding a buyer willing to overpay. Electric vehicles highlight the most extreme cases. In Q4 2024, the average negative equity on traded-in EVs hit $10,186, according to Edmunds. Why? During the shortage, dealers marked up EVs by $15,000 or more, and now their values are plummeting. A $65,000 Ford Mustang Mach-E that sold for $80,000 in 2022 might now be worth $38,000, but the buyer still owes $72,000. This leaves consumers trapped in a cycle of debt, unable to recover from inflated prices. Manufacturers, while publicly discouraging markups, are complicit in this system. Franchise agreements prevent them from directly controlling dealer pricing. Some brands, like Ford, have threatened to reduce allocations to dealers who engage in price gouging, but enforcement is inconsistent. Automakers also benefit indirectly. When dealers extract maximum profit, it makes the MSRP seem more reasonable by comparison. The looming threat of tariffs only adds fuel to the fire. With 25% tariffs on popular models like the Honda Civic and Toyota Corolla potentially on the horizon, dealers have another excuse to raise prices. One Honda sales manager admitted, "We're telling customers to buy now before the tariffs hit. But really, we're just using it to justify current markups." This system, from auction markups to mandatory add-ons, dynamic pricing, and artificial scarcity, ensures that buyers face inflated costs at every turn. Whether it's a base model sedan or a specialty vehicle, the deck is stacked against consumers, and the profits keep rolling in for dealers.